Cryptocurrency has changed the world of finance. From Bitcoin to Ethereum and thousands of other digital coins, crypto offers exciting opportunities to grow wealth, achieve financial freedom, and be part of a new digital economy. But while many people have made money in crypto, even more have lost it. Not because crypto is a scam, but because they made simple mistakes that could have been avoided. In today's video, we're going to talk about the most common crypto mistakes investors make and how you can protect yourself from them. Whether you're a beginner or someone with experience, this guide can save you from costly errors. One of the biggest mistakes in crypto is jumping in without proper knowledge. Many people hear success stories from friends or see social media posts about someone turning a small investment into millions, and they rush to buy crypto without understanding what they are buying. They don't know how blockchain works, what gives a coin value, or what risks are involved. Investing without research is like gambling. Before putting any money into crypto, you should understand the basics. What the project does, who is behind it, how it solves a real problem, and what makes it different from others. Knowledge is your first line of defense in the crypto market. Another very common mistake is investing money that you cannot afford to lose. Crypto is extremely volatile. Prices can rise or fall by 20, 30, or even 50% in a single day. Yet many people invest their rent money, emergency savings, or even take loans to buy crypto, hoping for quick profits. This is dangerous. You should only invest money that, if lost, would not destroy your financial life. Crypto should be a part of your overall financial plan, not something that puts you under stress every time the market moves. FOMO, or fear of missing out, is one of the strongest emotions in crypto. When prices are going up fast and everyone on social media is talking about a coin going to the moon, people rush to buy at high prices. They fear that if they don't buy now, they will miss the opportunity of a lifetime. Unfortunately, this often leads to buying at the top, just before prices crash. Smart investors don't chase hype. They wait for good entry points, follow a plan, and avoid emotional decisions. Remember, in crypto, patience often beats excitement. On the other side of FOMO is panic selling. When prices drop suddenly, many investors get scared and sell their coins at a loss. They watch their portfolio turn red and think the market will never recover. But history shows that crypto moves in cycles. There are big drops, but also strong recoveries. Panic selling locks in your losses and often leads to regret when prices bounce back later. Instead of reacting emotionally, it's better to have a long-term plan and stick to it, unless something fundamentally changes about the project. Another major mistake is not having a clear strategy. Many people enter crypto without knowing why they are investing. Are they in for short-term trading, long-term holding, or just experimenting? Without a strategy, they buy randomly, sell randomly, and end up confused and frustrated. A good strategy includes your goals, how much you will invest, when you will take profits, and how much loss you are willing to accept. Even a simple plan is better than none. In crypto, discipline is more important than luck. Ignoring security is one of the most dangerous mistakes in crypto. Unlike traditional banks, in crypto you are often responsible for your own funds. If you lose your private keys, get hacked, or fall for a scam, there is usually no way to recover your money. Many beginners keep large amounts of crypto on exchanges, use weak passwords, or click on suspicious links. You should always use strong passwords, enable two-factor authentication, and consider storing long-term holdings in a hardware or cold wallet. Never share your private keys or recovery phrases with anyone, no matter what. Falling for scams is another common problem. The crypto space is full of fake giveaways, phishing emails, fake websites, and guaranteed profit schemes. Scammers often pretend to be famous people, exchanges, or support teams and ask you to send crypto or reveal your keys. If something sounds too good to be true, it probably is. Real investments do not guarantee profits. Always double-check links. Never trust random messages, and remember that no legitimate project will ever ask for your private keys. Many investors also make the mistake of overtrading. They buy and sell frequently, trying to catch every small price movement. While this may look exciting, it often leads to high fees, bad decisions, and emotional exhaustion. Most beginners lose money by trying to trade like professionals without enough experience. For many people, a simple long-term holding strategy, also known as HODling, works better than constant trading. Sometimes doing less is the smartest move. Another mistake is putting all your money into one coin. This lack of diversification can be very risky. Even strong projects can fail due to hacks, regulations, or competition. If all your funds are in one asset and it crashes, your entire portfolio suffers. Diversification means spreading your investment across different coins, sectors, or even outside crypto, like stocks or funds. This doesn't eliminate risk, but it can reduce the impact of one bad investment. Chasing low-priced cheap coins is also a trap many fall into. Beginners often think that a coin priced at a few cents is cheaper and has more potential than Bitcoin or Ethereum. But price alone means nothing. What matters is market capitalization, supply, and real use case. A coin with trillions of tokens may never reach even $1. Instead of focusing on price, focus on the project's value, adoption, and long-term potential. Ignoring market cycles is another big mistake. Crypto markets move in phases. Bull markets, where prices rise fast, and bear markets, where prices fall and stay low for long periods. Many new investors join during bull markets when everyone is optimistic, and then lose hope during bear markets and quit. Smart investors understand that bear markets are often the best time to learn, build positions slowly, and prepare for the next cycle. Patience through cycles is key to long-term success. Not taking profits is a mistake that has hurt many investors. When prices go up, people dream of even higher prices and refuse to sell. They watch their portfolio grow, but never convert gains into real profits. Then, when the market crashes, those gains disappear. Taking profits doesn't mean selling everything. It means gradually securing some gains along the way. This helps protect your capital and gives you confidence no matter what the market does next. At the same time, selling too early can also be a mistake. Some investors sell as soon as they see a small profit, only to watch the price continue rising much higher. This often happens because they lack a clear plan. That's why it's important to decide in advance at what levels you will sell part of your holdings, instead of reacting in the moment. If you found this video helpful, make sure to like it, share it with your friends, and subscribe to the channel for more simple and practical finance and crypto guides. Thanks for watching, and I'll see you in the next video.